Samir Arora, fund manager at Helios Capital, joins us right now on the show. Samir, so good having you. Thanks much for taking the time out and speaking to us today. Good morning. Samir, was the budget the last straw on the camel's back? Because the veneer of India being the last bastion of growth in a world starved of growth also seems to be cooling off. India may be growing well, but nowhere at the rate that most managers would have anticipated at the start of the year.
Well, that is true, but actually we should not say that the budget was the last straw, because budget actually was okay. I think the tax part of it was the last straw. It was a perfectly fine budget and mostly would have been at least neutrally welcomed. But the tax thing was unnecessary, more the tax and then the way it was dealt with by sort of trying to justify it when it was clear that it was an unintended target. And it could easily, the government could have easily reversed it without being called, rollback kind of a government. It could have been easily adjusted. You can easily say that FPIs who are registered, any FPIs are registered with SEBI, and where will one NRI or one Indian to save a 2% tax be able to get a registration with a regulator which needs so many other things? So they can easily be carved out, but it was not done, and that I think was the bad part rather than the budget per se.
Okay, so let me rephrase. I was actually talking about that only. My question is, Samir, there is this whole host of commentary and we don't know what will happen, but maybe we'll go out and ring fence the FPIs because, as you said, it was an unintended consequence, etc. But then there is, if you wrote it back here that if you're doing that for a select set of investors, why not do it for all, etc., etc., etc. So if this doesn't get rolled back, then do you reckon that the kind of selling that we've seen, and again debatable whether that's happening because of the lower growth or because of the tax or a combination of both, but the kind of selling that we've seen in the month of July thus far, can it get exaggerated or can it stay continuous?
No, actually, first of all, it is unfair of the public which is saying that, how can you tax Indian and not FPI? Because first of all, either the government should say it is taxing FPIs. It is saying we are taxing rich Indians, basically. You can't decide to tax rich Americans. And so this fact that it's a structure makes it that it is unintended. It is not to say how can you tax Indians and not tax foreigners. You're not taxing Indians. You're taxing rich Indians, which is not the same as taxing FPIs. These are different battles and have to be fought differently. So it is wrong of the Indian high net worth crowd to think that, because you are going to let go of FPIs, you should let go of Indian rich. It's a different debate. Second thing is that I don't think the selling is necessarily related to this tax, because the pain of tax will be, and that is the sad part, it will be not visible to you, as in to anybody, forever. But when you get $5 billion inflows, please remember you could have got 10. And when you get 10 one day, please remember that time that you could have got 15. But if anybody thinks that it will be forgotten in a bull market, actually it will be exaggerated in a bull market, this tax. So let's just see. So right now, it doesn't matter to an investor whether he's paying tax or not, because he's not making any money in the first place. But let us say a year like 2017 comes up, which will come up one day, and the market goes up 30%, and therefore the guy who's paying taxes goes up 26% because he's paid an average of 15 to 20%, whatever, 22% tax. So he's gone up 25%. At that time, he will think that he's done as well as the index, but he would be 5% lower than the index. So the ETFs, people will stop looking at Indian ETFs, because without analyzing, they will think that these ETFs are not able to replicate the index that we have asked them to replicate. And generally, in a bull market, if you lose 4 or 5% relative to the index, and broadly the bull market, when it happens, will be in all markets, hopefully, you will on the margin keep losing investors who will think that the Indian market, the cost of, because it's a cost, because 50, 60, 70% of these investors don't pay taxes in their home countries also, because they are either sovereign funds, pension funds, or they are from Singapore or Hong Kong or somewhere else. And even in US, it is not clear how they will take tax credit for taxes paid in India. So basically, this is a cost of investing in India. It's like a expense ratio going up 200, 300, 400 basis points in a bull year. How can anybody manage that? It's very difficult. Right now, nobody realizes is Not because the tax is lower, but because the pre-tax income is not high enough to make any difference to anybody.
Yeah. So, Samir, good morning. Just to come back to the flavor of the market at this point, is this sentiment a bit worrying? The lack of interest to actually enter even after the markets have corrected about 600 to 700 points from its highs, and the sitting on the fence kind of an attitude?
Well, that is also correct in some sense, because these things somebody can still ignore if the market, independent of this, is doing so well that somebody says, okay, I will make less, but I'm making 10, so I'll make 8. Okay, let us say, and it's an expense also, let us say. Even then people would come in. Some people would come in. That's a problem. We will never be able to know the cost of this except because it's not that you will have massive outflows every year. So if you get, as I said, 10, you should have got 20. That is my theory. But right now you need something else to go on, and I feel that will happen in the next 6 months, because I think this market will bottom not today, tomorrow, but maybe in October, November period, for a few reasons. One is that the slowdown in the NBFC crisis started in September last year, and therefore in that sense you can say that the numbers will be in the base when we look at the last quarter, this October December quarter and moving forward. Secondly, we would have had 2 bad years, 18 and 19, even though in 18 the index seemed to be up, and even now it seems to be up, but we know it's not really at a broader market level. And we rarely had 2 bad years since I've been a fund manager in 93. From 93, I think only in 2000 and 2001 did we have 2 consecutive bad years. And also, if we say that the markets discount at least 6 months ahead of time, then in a sense you're even covering the following 6 months, that even if the slowdown is there. Right now there doesn't seem to be any motivation for anybody to start buying, because they are in a bad market. You are upsetting them, so it's like double whammy.
Yeah, and is that true? Does it hold true for the total ignore of the broader market space? While obviously they really don't chip in when the markets move up, they are actually the bigger contributing factor when the markets start falling. So they've got literally no support coming in from anywhere.
Broader market cannot get support because the broader market is being attacked regulatory wise, in the sense, if you say that we will now go after anybody who's ever been an independent director of any company which has done something wrong, half the directors will resign on their own ahead of that, because they don't want to go through the bother of being, their accounts frozen, like it has happened in the case of Nirav Modi's companies, is Wipro CFO and all these guys who are supposedly big guys, poor guys, getting their assets frozen. So now what happen is mostly these things will happen in smaller companies. If you say that auditor will resign under pressure, mostly it'll happen in a smaller company. Mostly if you say directors will resign out of not necessarily having found something wrong, but being scared of not getting into these things and saying, what is the point if the company is small and I am big? Why should I be associated with it? And so things like that will happen mostly in smaller companies, mid-cap companies. And when it happens in one mid-cap company, then 10 other companies which look like it will be under pressure. So right now you are trying to clean up everything so fast. And obviously that impact will be on mid-cap-ish, small-cap-ish companies rather than the big companies. Big companies have done badly in the last few days, but I still think they will do better than the average market for the next 5-6 months, till for whatever reason it broadens, the market rally happens. And one reason could be even this tax thing reversing, or anything which makes the market feel that the government is listening to the market.
You think that's the bigger factor, or the other part, Samir, wherein the commentary from most corporates seems to suggest that growth is a challenge? Forget the Nifty 50. The broader end of the spectrum, almost any SME that you speak to is starving for any kind of liquidity that could help it stay afloat and run the business. Forget growth.
I agree. But that, as I said, there are 2 things here. One is that, as I was saying initially, that in a bad market, otherwise bad market, you are trying to get FPIs upset. You're trying to clean up the country in a bad market. Bad market means in a bad economy or a slowing economy, and then putting so much pressure on all the participants that if you're a fund, mutual fund, and you've lent money to these guys, you are bad. If you are an auditor, you are bad. If you are a rating agency, you're bad. If everybody is bad, that can happen in an otherwise strong economy where you can handle. Now you forget about raising animal spirits. You have basically scared people into doing nothing. And so in the same way, the customers are also not buying because they are also scared in some sense about, taxes or whatever. So yeah, right now it is bad, but I still think, because I am looking at two things. One is if you're always in the moment, you will always be either very bullish or very bearish. At one level, that is true. But the second is to remember that how these markets turn, what is the history, that broadly nearly everywhere equity does better than debt over long term, that it's a good time to buy when others are selling. Those things are also important to remember, need not be fully followed through on day one. But those things also have a long history. That buy when times are bad, buy when this is happening, buy when there's a slowdown, but it's unjustified because there are some other broader trends which have worked for 100 years and they will not change also immediately.
Well, history may not repeat, but it may rhyme. But that's the question then, Samir, so many charts and so many different permutations and combinations which suggest that mid caps and small caps are at levels from where they'll bounce back. The question is, when you have an HDFC Bank, when you have some of the other large ones, suggesting that the next 2 or 3 quarters warrant caution in more ways than one, the growth will not come in immediately in the smaller names. So would you be comfortable buying into smaller names? Because as you said, history may repeat and at some point of time there'll be value found.
Because we are long short, we get some frustration out of our system by shorting. But in general, I would think that the market bottoming, forget about one stock which we may buy also one of these days or have bought last week also. But in general, I'm talking not any one name, because there'll be always some name which you have and you like and it's fallen and you think, oh, how bad that is. But in general, the market will not bottom right now. I think it'll take, as I said, maybe till October, December quarter. Because then, if nothing else, you'll be at least on year-on-year numbers, even if everything is much lower than 1 year ago. But you know how this world works. It works on year-on-year growth rates and all that. And then it may look a little better. Also, you see, look at the sectors and how they're being aggressively blown apart in some sense, not necessarily by anybody's action, but the way the world is working. So disruption in auto industry. Now, if you say that EVs, at least in two-wheelers and all, will come by 2025. What does that company also do? Does it immediately start discouraging its current this thing that it can't invest more in the current technology or in IC or the engine, internal combustion engine or whatever, or does it immediately move? Because we know that when disruption happens, mostly it is done by new companies. Even investors, should they buy a company where they may think that the terminal value will be significantly hit because by 2025 you can't do your current activities? Forget about the individuals who are buying these scooters. Should they wait for policy? Should they wait for charging stations? Should they wait for the tax benefits that actually have already come through? Things like that. It confuses everybody, and markets and stocks don't like confusion. So there's so many things happening simultaneously that in the same environment, to actively go against a group of investors which everybody knows has been unfairly hit. By the way, I am doing this on behalf of my anonymous friends who don't come on TV, because we are not even affected by that one bit, because we are not structured as a trust. But it's sad that the people who are affected either are so big or so compartmentalized, the fund managers, that they don't care what the operations guy or the NAV tax who's responsible. They just say, sorry, my job is to buy HDFC Bank and that is the end of my job. You ask the big guys, do they even know how these taxes are calculated? They won't know. The fund managers, that is. That this state is.
Samir, just last few questions before we wind down. So then what exactly, according to you, are the safer haven investments in a volatile environment like this? Because up until now, those that were touted, their valuations are starting to get challenged a bit more. So does one then take the approach of probably even shifting asset classes, according to you, or that would probably not be an option because you don't want to miss the turnaround once it actually happens in the equity markets?
Not to miss the turnaround, it is to know by looking at 100 years of data we have for 16 countries and for US for 200 years, that over long periods of time, which the long period itself may change in how long, but that equity beats your own, that same country's government bonds by 5% per annum. This is data if you had invested before 1929 in US or before World War II started in 1939 or so in Japan, and even they had a bomb thrown on them. Even then, from 1939, if you had just in whatever you had invested, never averaged, but only reinvested the dividend, you would have outperformed their own country's bonds. So that is the bigger picture. So it's not a matter of missing one turn. That is the reality of equity markets. And therefore, this is not a question of all or none. It is not that now I will take out everything and in December when the market comes in. So even though today I feel that I have, that markets are not going anywhere and they may mostly fall because I don't know. This is my guess. I will on the margin reduce my net long position by 10-15%. Normally we are at 60% net today because we feel a bit down. So the last month or so we are at maybe 45 net, but we won't go to 20 net and we will not go to 80 net even if you are very bullish. In the same way, the long only mutual fund guys who may be 98% when fully invested, they may go down to 90%. That and in between, if they're average, maybe 95. So everybody is doing this within their range of their mandates. And therefore, that is how fund management works. And that is why people who don't easily give up make money, because they don't go all or none looking for one heaven or the other. You will still have these same stocks. Can you today say that because HDFC Bank fell yesterday, it should not be in your top 5 stocks? But there must be 100 people who don't have it in the first place. So if somebody thinks now he'll wait for 3 months and then buy these things, once in a while it may happen for somebody, but that's not how you can consistently build returns or even build a portfolio.